Welcome to Coverage Clarified, where we make insurance simple, clear, and jargon-free. Today, we clear up common misunderstandings beginners often have about term life insurance and whole life insurance, so you can understand how each one actually works. Term life insurance provides coverage for a set number of years, while whole life insurance is designed to last your entire lifetime as long as premiums continue. This video is general education only and not financial or insurance advice. Everyone's situation is different, and rules vary by state and insurer, so always talk to a licensed insurance agent or a qualified financial advisor before making decisions. Many people hear that one type is always better than the other, or that one builds savings everyone can use without limits. In reality, both products serve different purposes, and the right fit depends on your goals and budget. We will walk through how each works with everyday examples and point out frequent myths so you know what questions to bring to a professional. Term life insurance gives protection for a fixed period, such as 10, 20, or 30 years. During that period, if the insured person passes away, the policy pays a death benefit to the named beneficiaries. Once the term ends, coverage stops unless the policy is renewed or converted, which usually costs more. Premiums stay level during the term, in most cases making it easier to budget. The policy does not build cash value, so there is no savings component you can borrow against while you are living. Many families choose term coverage when they have children at home or a mortgage because it replaces income for a known number of years. Because there is no cash value, the premiums are generally lower than whole life for the same death benefit amount. It is important to ask whether renewal or conversion options exist and at what cost, so you understand what happens when the term ends. This is a good question for a licensed agent. A common misunderstanding is that term life insurance is wasted money if you outlive the term. The policy is not intended as a savings vehicle, but as temporary protection during the years when others depend on your income. If your children finish college and your mortgage is paid, the need for that coverage may simply no longer exist. Some policies allow conversion to permanent coverage without new medical questions, which can be useful if health changes. Another myth is that term is always the cheapest long-term option without considering future needs. In reality, if you still need coverage after the term, you may face higher rates or have to qualify again. It helps to think about whether your need for protection is temporary or ongoing before choosing a term length. Ask an agent how conversion works and whether the policy can be renewed at older ages so you are not surprised later. Whole life insurance provides lifetime coverage as long as premiums are paid. Part of each premium goes toward the death benefit, and another portion builds cash value that grows over time at a rate set by the insurer. You can borrow against that cash value while you are alive, though any unpaid loan reduces the eventual death benefit. Premiums are higher than term for the same death benefit because of the lifetime guarantee and cash value feature. The policy never expires during your lifetime if payments continue, which removes the worry about living coverage. Some people appreciate the predictable premiums that do not rise with age. Cash value grows slowly at first, and then more steadily, so it is not a quick savings tool. It is useful to ask how the cash value is calculated and what happens if you stop paying premiums, because different policies handle this differently. A frequent misunderstanding is that whole life insurance is primarily an investment that will make you wealthy. The cash value does grow, but usually at a conservative rate that is lower than many market-based accounts, and it comes with insurance costs deducted along the way. Access to cash value through loans is available, but it is not free money since interest accrues and the loan reduces the death benefit if unpaid. Another myth is that the cash value can be withdrawn without any impact on coverage or taxes. In most cases, loans are tax-free, but surrendering the policy can create taxable gains. The product combines protection and a savings element, so the overall return is usually modest compared with separate investments. Ask how the illustrated cash value growth compares with other savings vehicles and what fees are involved before deciding if this fits your goals. The main difference is duration and purpose. Term covers a specific period at lower cost, while whole life covers your whole life at higher cost with a cash value component. Term does not build savings you can access, and whole life does, but that feature increases the premium. Another difference is flexibility. Term can be allowed to end when needs change, while whole life continues unless you stop paying. Some people use both by having term for high-need years and whole life for permanent needs like final expenses. It is easy to assume one is always superior, but the choice depends on how long you need protection and whether a cash value feature matters to you. Because state rules and policy details vary, ask an agent to explain the differences in your own situation rather than relying on general comparisons. When speaking with a licensed agent, bring specific questions to understand your options clearly. Ask how long you actually need coverage and whether term or whole life better matches that time frame. Ask what happens at the end of a term policy and whether conversion is possible without new health underwriting. Ask how cash value in a whole life policy is calculated and what fees reduce its growth each year. Ask what happens if premiums are missed and whether the policy has any riders that affect cost or benefits. Ask how the death benefit is paid and whether beneficiaries can choose lump sum or other options. These questions help you compare policies on equal terms rather than focusing only on premium amounts. Because every insurer structures policies differently, the answers you receive will be more useful than general online descriptions. Term life insurance offers affordable protection for a set number of years, while whole life provides lifetime coverage with a cash value feature that grows slowly. The choice depends on whether your need is temporary or permanent, and whether you value the savings element enough to pay higher premiums. Common myths include thinking term is always wasted if you outlive it, or that whole life is a high-return investment. Neither view is fully accurate. A good next step is to list your financial goals and how long dependents may rely on your income, then discuss those details with a licensed agent. Subscribe to Coverage Clarified for more plain explanations of how insurance works. Remember, Coverage Clarified is general education, not financial or insurance advice. Everyone's situation is different. Prices and rules change and vary by state, so always talk to a licensed insurance agent or a qualified financial advisor, and check current details with an official source before making any decision.